to today's more important chart appraisals with me, Rich Paramarket Analyst at Hantec Markets on Monday 24th of July. We've got a fairly sort of dollar negative session developing again. We had a big sharp move against the dollar on Friday, and that sort of early doors today had sort of looked as though it wasn't continuing, but certainly has done in the last few minutes anyway. We've seen that as the Treasury yields have continued to fall back. We've seen on Friday concerns over Sean Spicer resigning from Trump's president's, from his administration. That sort of added the political risk that's been sort of ongoing really to Donald Trump's presidency. And that fact that Treasury yields are sort of falling away again has put pressure on the dollar. Dollar sort of also pressured last week by that big breakout on the euro. But we really are seeing that sort of move continuing really today. Interesting that we've seen the euro basically not, here we see the markets board, the euro has not really moved today. I mean, and that's come despite the fact that the dollar has been weaker against sterling, yen, euro not especially sort of gaining the grounds on that move, and that's basically become a reason because of the manufacturing PMIs, the flash manufacturing data that we came out of the eurozone today, disappointed across France and Germany, and the eurozone data as a composite as well. So it was it sort of meant the euro is underperforming a touch today, and you can see that on the FX. That dollar weakness that we have got, as I said earlier on, had looked to be finding a bit of support, but's fallen away, and that has resulted in gold also finding support again. And it's interesting that we're seeing equity markets under real pressure, because we saw the move on Friday being the equity market sort of being really hit by that stronger euro, the outperformance of the euro, but the sort of political risk and the breakdown of that move on Friday is really sort of hitting markets again today. FTSE underperformance driven by positive sterling performance, I think, broadly speaking. But yeah, we're getting some continuation of these breakdowns on these equity markets. So my chart today is the DAX, and I'll show you through that chart in a bit. But certainly it looks like equity markets are under increasing pressure as these treasury yields continue to fall away. Now, in terms of economic data today, not a great deal apart from flash manufacturing PMI for the States. Where is it? Here we go. Not a huge amount. Bit of flash manufacturing PMI for the States. Mild improvement on the services PMI, but manufacturing basically as is. Existing home sales as well. Expected to drop by sort of about 1% really. Not a million miles off it, to 5.58 million. But yeah, nothing really doing there. So not a huge amount to really get us going today, but certainly markets are looking pretty risk off at the moment, with yen outperformance, gold outperformance, and treasury yields falling. So my chart today is the DAX, and the DAX. What's that? 1, 2, 3, 4, 5, 6. We're into the 7th day potentially of decline now, or I should say bear candle, because obviously that was a rally day. But 7 days of bear candles has really changed the outlook on the DAX. If I zoom out here, you can see this sort of top pattern that we had on the DAX. That was 460 ticks. Gives us an implied target to the downside of 1230. We're only 120 ticks away from that now. And it looks pretty negative on the momentum indicators, doesn't it? And I think it's coming back towards a test of this big blue uptrend, which is the primary uptrend on the DAX. Now we're also, as we speak, coming back to that 144-day moving average again. Now that is a key level as well. So we are really at some important moment for the DAX. So you've seen supports failing. You're seeing sort of market rolling over. Old support becomes new resistance. So you're looking at 12,319 being that old key June low. That becomes basic resistance now between that and 375, which again was an old high, which became supportive, but broke to the downside, that now becomes a whole area of overhead supply from the last few weeks. So watch out for that if you do get a technical rally, but at the moment certainly the market is continuing to the downside. You've got that uptrend that comes in at 1267, but yeah, certainly 1230 I think could easily come under pressure, and you've got that reaction low of 11,940 from April. So that is a key low. If that goes, then that would be a really important level to sort of lose to the downside, because that would be real confirmation of not only the uptrend broken, but also then the old key higher lows within the uptrend are being broken as well. So it really does suggest a change in sentiment if that were to be seen. But at the moment, obviously, we've not yet broken that uptrend, but we are certainly corrective near term. See the hourly chart where you've got negative configuration across the momentum indicators. Rallies are a chance to sell at 60, rallied to 60, failed. Now it's sort of struggling underneath 30, so anything around sort of 30 to 40 I think is a chance to sell really. You've got the overhead resistance from that late rebound, 12 to 40. But as I said, 12319 is the key resistance where that overhead supply starts to come in. So with that in mind, I wish you good luck in trading, and I'll speak to you later. Thank you.